as what we are seeing right now in the US or probably some parts of Europe as well. So starting with GDP growth, as some of you may know, China actually has a very solid target to double their 2022 GDP by 2035. So that means from now to 2035, at least annually, they have to grow somewhere between 4 to 4.5 per year from now to 2035 on average. So what we think is that it will be a step down kind of 5-year growth average moving forward. And hence we are still thinking that at least this year, we are probably going to see above 5% at least GDP growth. So China has this famous saying from President Xi Jinping that they are now not focusing on high growth, but instead they are focusing on high quality growth. But for us, we believe that the numerical target is likely to stay. So the growth that we have been seeing in the past are probably driven by mainly consumption and investment. But 2021 was a unique year where the major economies globally, other major economies globally are recovering from COVID. Hence, the exports from China was extraordinarily high. Hence, 2021's GDP growth was actually largely driven by net exports. As you can see from this chart, other than net exports, actually the rest of the matrices are pretty weak, especially towards the end of the year in 2021. So in 2022, what we are expecting is that investment growth will come back in some way, because Chinese government has already committed to front load what they call fiscal policy, and also they're probably from a tax rebate or tax burden reducing side, companies might be able to spend a little bit more on investing in their own capex as well. Other than that, we are hopeful that we will see some kind of a recovery in consumption as well, but that also hinges on how China will handle COVID moving forward. We will touch upon that sometime later as well. Okay, so this is a very important matrix that we watch out very closely. It's called credit impulse. For the benefit of all audiences, credit impulse is a ratio where in a very simple way, very simplistically, it means that for every extra credit created, for every extra unit of credit created, how much strength can this in terms of producing an extra unit of GDP growth? So an extra of unit created, how much strength it can boost extra unit of GDP growth. So you can see that from this chart, 2021, the yellow-orange line plunged into the negative territory towards the second half of 2021. And we are expecting this to rebound in this year. So why is this important? You will see another chart later on that one of our thesis hinges on this credit impulse rebound as well. Moving forward, China is one of the rare major economies in the world that are likely to be easing. In fact, they have already started easing. So if you have been following the news, they have been cutting interest rate, they have been cutting triple R for the banks. So China, looking at this chart, you can see that places like countries like US has already started tapering, talking about rate hikes probably starting from March, even to the extent of balance sheet reduction or whatnot. But China is one that is going against that flow, what we call decoupling, where they are likely to be moving ahead with an easing bias at least in this year. So signs of easing, like I've mentioned, they have started to cut interest rates. They have started to cut lending rates. So we have seen one just yesterday as well, which is a strong signal. Hence, moving forward, we do expect that they will continue to do it, albeit that each time they might be doing baby steps, for example, 5 or 10 basis points kind of cut, because it is not a Chinese style to do in Chinese what we call 大水满灌 or flooding the system with credit. It's just not their style. So they will probably continue with their baby steps and one step at a time. So we do expect further cuts coming at least in the first half of the year. On inflation, so China, you can see this chart, China is not really facing a huge inflationary pressure at the moment. And we are observing that food prices are actually declining or peaking out in China. And on the producer side as well, the cost pressure is also declining. Some of you might notice that the raw materials, metals prices were very, very high last year due to several reasons. But we are seeing these raw mat price are also turning around. For China equities, so if history does give any lessons, it will be a year of hope, as you can see in this very nicely charted picture here. So, but in 2022, we are not expecting that it will be a strong earnings year. I think earnings will still be normalized, but it will probably be a year more of a PE or so-called valuation recovery year for China. So for China itself, where would we put our money in? We do see that there will be more opportunities in the growth sector. So again, back to this credit impulse chart that we have seen just now. Historically, on your left, the chart on your left, historically, MSCI China growth will have a pretty good correlation with credit impulse. So hence, given that our view that credit impulse is likely to rebound in 2022, growth sector should perform better. And looking at valuations perspective, MSCI China has actually underperformed its regional peers pretty badly in 2021. Hence, the chart on your left, you see that it's a rare case where they underperform so severely. And on your right, from a PE perspective, from valuations perspective, they are pretty attractive as well at an attractive level. So you might be thinking that it's probably all because of internet. But if we take out internet from the index, actually the valuations is quite okay as well. So key themes in 2022, and maybe it will prolong towards 2025, are these. We are seeing that for obvious reasons, China is spending a lot of effort in ramping up the advanced technology. This includes things like robotics, automation, chip makings, 5G, and etc. Other than that, China has made a huge commitment in boosting their renewables. We are seeing that China is going to spend a lot of money on smart manufacturing as well to increase productivity. And this is partly because they are facing challenging population trajectory moving forward, aging population, and things like that. So you might have heard the term common prosperity. It is some kind of ideology that's happening in China right now. But what we think it implies is that the middle income group or the middle income population is likely to grow. Hence, we will see certain companies or certain sectors to benefit from a rising or growing middle income population. And lastly will be a resilient staples. So we still think that spending power within China is pretty solid. Hence, things that is what we call staples, like your food, milk, rice, water kind of thing. So all these things are still going to see solid demand and growth moving forward as well. So these are the key 5 themes that we identified in China for 2022. What are the key challenges? Very quickly to touch upon this. First of all, most of you have heard about the news of Evergrande and increasingly more names that appears in the news that are likely to default in the property space. So indeed, property sector is very, very big. It's estimated to be contributing directly or indirectly at least 25% of China's economy. So when we look at this chart, not only that investment is falling, not only that money spending is falling, but also more importantly, the home prices in China, we have seen that it has declined 4 consecutive months of decline. So with home prices declining, the home prices expectation is also pretty weak. Hence, it's sort of a viral it's a viral circulation. So moving forward, what we see right now is that government is sort of easing at the margins. They are trying to do targeted specific easing on the property sector. It is still yet to be seen. Well, how huge or what kind of impact can this bring? But the challenges remains. If property sector cannot stabilize, China's economy will likely to weaken further. And then with zero COVID strategy. So this is the daily new cases confirmed. Thank you everyone for signing in back again. Thank you very much for sticking by. So where we cut off just now was that what are the key challenges that probably China will be facing this year? So very quickly on property sector, I guess we have run through it just now. So secondly will be on COVID. So regardless whether you believe what China is reporting, whether it is true or not, I think more importantly is the trend of these new confirmed cases, where looking at this chart, since the second half or towards the end of November last year, the trend has been going up. And in China, they are still sticking by this strategy called zero COVID strategy, where in any area or any town where they identify just one confirmed cases, they will do strict movement restriction, they will do mass testing, and they will sort of, even for a very short time, shut down that particular area. So this is something that is very detrimental to the economy. Hence, we see that fourth quarter last year, actually GDP growth weakened quarter on quarter. But the key question here is whether moving forward, will China sort of have soften their stance on this zero COVID strategy? And what we think is that before the Winter Olympics is very unlikely, but toward post-Winter Olympics in Beijing and moving forward, if they are still unable to contain, especially with this new Omicron variant that is very infectious, they are likely to maybe in some ways soften their stance on this. But if they do not, we do think that consumption as a whole will continue to be hampered in this environment. Of course, foreign relationship is also a big challenge for China. For us, we do not believe that US-China relationship will improve. But at the same time, we don't think that it will probably worsen from here. Both sides have their own agendas domestically. US is going to have the midterm election. China is going to have the so-called NTC by October, where President Xi is likely, highly likely to remain for his third term. So both sides have their a domestic agenda, so probably they will spend less time fighting. But at the same time, we don't believe that, we don't think that things will get easier between the two. So in conclusion, three things. China economy is likely to be okay, to be supported, rightly so that government currently from the fiscal policy side, from the monetary policy side, both sides, they are more proactive right now. Secondly, will be that in terms of equities, the market for China specifically, we do think that valuation could see a recovery, if not full, but then growth will be our preference. And thirdly, which is very important for us, is that be nimble and don't be too stubborn in a way. Like some things that I would like to share with our audience is that we can spend a little bit more time thinking like, is the China today and for the coming 5 to 10 years the same as the China we saw in the past 10 years that probably many people made a lot of money from? Are the internet guys, are the internet giants going to remain as the key players in the market, or there could be a new reshuffling, or there could be a new focus moving forward? I think that is something that probably we will not see or notice overnight, but it is a question that we are asking ourselves day in, day out, where the next opportunity lies. And if China is not going to be the same as compared to the past 10 years, what has changed and where are they changing to? And that would be the opportunity that we are going after. So be nimble, and we have to change when China change, because we are in the capital market of China trying to play their game. Hence, we have to follow their rules. Hence, we have to be very, very flexible and diversify. Is the way to go, at least for the market that is changing pretty quickly. So so that concludes my presentation today. We will open up for Q&A for now, if there's any question.
Okay, there's one question from Sam. Do you see any China index A50 will go up based on the good factor?
A50, I assume that you are speaking of the from the A-shares perspective at the domestic market. So what domestic market is very different from the H-share offshore market. I believe that if most of you have followed China for a while, you would be aware that the key difference between A50 or domestic market versus H-share market would be that the index component is very different. On the A-share side, the large caps are still mainly financials, are still largely consumption or consumer related companies. So if the view is that financials is going to outperform, if the view is that consumption is going to outperform, then A50 or so-called domestic market is where you would want to invest in. So my view is that from the H-share side, which has done very badly in 2021, when we talk about valuations recovery, probably the opportunity is where it lies from a valuation perspective. But I'm not saying that A50 is going to perform very badly, but just a relative basis is that I think the opportunity of upside will probably come from H-share side.
Okay, thank you, John. I think most of the question they are asking about the China A-share and H-share, which one will be favorable in 2022 lah. I think you have answered that as well.
Just let me add one point. I think we have to be aware that what will push the H-share market. So if you look at Hang Seng or if you look at MSCI China as a whole, about at least 1/3 of the index is made out of Chinese internet or so-called new media stocks. So if we have the view that this will continue, I mean, if we view that internet stocks are continue to dominate, if we expect that probably regulatory pressure is over, then you can probably stick to this. Otherwise, then if we have the view that this is probably the best time for them is gone, then probably we'll see some time in adjustments in the index. To give you some background perspective, in the past, maybe 30 years ago or 20 odd years ago, index for China, the largest ones are the telcos, right? Your China Mobile, China Telecom, China Unicom. And after that, you are the banks. They were the banks were the heavyweights. But 10 years later, it became the internet guys, which became the heavyweights in the index. So the index itself is changing, is adapting, is shifting by sort of 10 years each. So moving forward, are we expecting a change in that side? So I guess that will give you an answer. If you are confident that China internets are to come back, then that is where you want to be. But if you think that probably not, something might be changing, then we have to remind ourselves that probably we have to change in our thinking as well.
Okay, thanks, John. There will be another question from YouTube. So further on your answer, would there be the China will be still taxing or they will still impose the penalty on those giant technology company going forward? What is your view?
Great question. My view is that it will go on. My view is that China internet giants will continue to suffer from regulatory pressure, but the nuance here is that the intensity of new regulations might have already been behind us. So what do I mean by that? So last year, 2021, is that almost every week we see a new regulation out to control this and that, from advertising to antitrust to platforms and whatnot to take rates. But then moving forward, are we going to see new regulation every week? I think probably not. I think where we are right now is the implementation phase, where the written laws are already there. This year is the year for internet companies to comply and comply strictly. And probably it takes time as well for Chinese regulators to come to step in and execute, because when you have written law, you need to execute it. And it is not something very easy. It's a very huge economy in terms of internet or digital media economy as a whole. For Chinese officials to learn and step up their game in order to control or rein in these big giants, it takes time as well. So moving forward, it will be more likely we will probably see news like who gets fined, who gets caught, who gets named, rather than new regulation every week. Okay, so I think that's what has changed. So in short, I think they will continue to be under pressure. I think that from a bottom-up fundamental perspective, we will continue to see changes in their business model in order to comply with what government wants. But in terms of intensity of new regulations, I think we have already gone past that.
Okay, thank you, John. So, okay, there's another question from one of the attendees here. For China-Asia market, what will you comment on the recent rotation for EV, electrical vehicle, or semiconductor to financial and consumer paper? Will it be the last for the whole year? And what is the benefit sector for the interest rate and RRR cut?
Okay, great question. Okay, so one by one, right? We are talking first. I'll address value rotation. Okay, what happened in the first three weeks, right? In the Chinese market, we see EV sectors being taken off profit, and then they are floating money into things like financials, like you have mentioned. I think what is happening here is really 2021, in a very, very bad year, investors that had made a lot of money in EVs are taking profit, and I think that is a very wise move. So by taking profit at the beginning of the year, it gives them the bullet to prepare for the rest of the year. So in China, we have to remember that for the economy to really kickstart, it actually starts after Chinese New Year. So basically, practically, usually in the first month, is a warm-up phase for China economy or China market. So when you prepare your capital for the rest of the year, I think after Chinese New Year is where the game really starts. So is this rotation something that will last? Okay, to be honest, I can't say for sure. I don't really have a crystal ball. But in my view, banks, properties, and things like this, these are very cyclical in nature. So in a very general way, cyclicals have a timing. So it's not something that you can probably see them go for a very long time. It goes in cycles. But things like EV, renewables, things like energy transformation. So that is where that I think moving forward, China will spend a lot more attention and spend a lot more time and money in. For example, how to effectively or efficiently ration your energy when you are starting to cut off so-called your carbon dirty energy. And when we are talking about EVs, penetration rate is higher. How are they going to continue to have this penetration improve moving forward? Where are they going to spend? Is it the charging stations? Is it the battery improvement? We still have a lot of technology innovation going on within the EV space itself. Semiconductors, China is definitely going to keep on spending because they are still very far off as compared to their mature peers globally. So they don't want to be choked. Hence, they are going to continue to spend. So those are the areas that I think there's a very, very long runway, structural way. Of course, in between, there might be cycles. But the question here is that, do we want to trade in and out every month, or do we really want to find a big direction and let's just invest our money in and look for the long-term gains where we can reap benefit from? Sorry, you have the second part of the question, right?
Yeah. The second part of the question will be, how will this company be affected by the RRR cut?
Sure. Okay. RRR cut. Okay. Firstly, I think probably for the benefit of all audience, what is actually RRR? RRR is a ratio, is the portion of money where banks have to keep with the central bank. So every commercial bank will have to store some money with the central bank. And when RRR is being reduced, means that commercial banks have a little bit more money to lend out to the real economy. So that's what RR really is. So when RR cuts, in some way, it helps eases banks what's it called? Banks capital's cost, funding costs. Okay, but when RR is being cut, but at the same time, lending rate is also being cut. Hence, actually, it's pretty neutral for the banks. In our view, it's not going to be really impactful to them. More importantly, RR cut to us is not really a very powerful tool to the economy. Hence, to answer the question directly, no, we don't think that RR cut itself will benefit any specific sector. But RR cut is a very good signal that what government is doing. So RR cut shows that government is seeing and acknowledging that yes, the economy needs more liquidity. RR cut plus lending rate cuts also gives a signal to the market that yes, we are going on an easing cycle right now. So I think that's more important to the whole economy itself. Thank you.
Okay, John. So I think I will ask one last question over here. On another aspect, what is your view on the US and China tension? Will it be still continue in 2022, and will it still affect the either China A or China H market?
Sure. I think I sort of touched on this topic, but to elaborate a little bit more, in US itself, the Republicans and the Democrats, they disagree with 99.9% of things in the world. But if there's one thing that both of them agree on, is that they are both negative towards China. Hence, from that perspective, they are not going to get easy on China anytime soon. We don't think so. From China's perspective, when US is so hostile to them and probably ganging up with other countries, China itself is probably not going to step down as well. So with two sides being pretty hard on their stance, I don't think that there will be any improvement or meaningful improvement moving forward between the two countries. What I will be watching out for is that will there be more conversations? Meaning, will there be more high-level talks between two sides? Even though that sometimes on the surface, we don't see any big announcements from any side. Sometimes it feels like that. But the frequency of conversation to me is actually a signal, because when two sides, when high officials meet together, something must be going on behind the scenes, that something might have already been agreed behind the scenes before they come out and talk to each other before the media. Hence, when the frequency of talks, if the frequency of talks increase, I think that's a good sign for both sides. But at least from an economic perspective, I think both sides have their domestic worries, have their domestic agenda to handle in 2022 itself. So probably not too much action that I think will be going on between the two. I think what is probably more imminent currently will be on the ADRs, which is the Chinese stocks that are listed in the US. Those are facing delisting pressure. I think that is the one big thing that I think will probably really happen probably in 2023 or 2024.
Okay, thank you, John, for answering all those questions. And then I think because of time, then we thanks John for sharing on these Chinese market